All right. Good evening, everybody. How's everyone doing? Let's have a quick check in. You can interact in the chat, ask questions if you have any. We'll be sure to cover them. Let's make this an interactive evening. That's a goal for tonight. Welcome back to Cashflow Sundays. We'll be doing this every week live over here on Twitch. In this live stream, our goal is to tell you about everything that has happened in the stock market last week, everything that's going to happen. We'll be doing some stock analyses, but most importantly, you can ask questions about stuff that's going on in your life, in your portfolio. You can ask us questions about how our software works. Nothing is off the table. If you have your own surprise of the week, be sure to share it. I'm very interested in what your surprise was last week. For this evening, we have the following topics to discuss. Let's take a quick look at my notes. We have the news of last week. I think a big one were the Fed rate cuts. We've talked about this quite a lot in the last few live streams. We'll be talking about Nvidia investing in Intel. I think that's a bold move, strategic move. We will be talking about Oracle taking a stake in TikTok in the US conglomerate that will be managing TikTok. I think that's an interesting phenomenon as well. It's quite a geopolitical space that we don't see quite often. And we'll be talking about the September effect. I heard a buddy of mine talk about this, that in September, stocks always dip. That's apparently a historic fact, but what's going on? We'll talk you through it. We'll be having some investment tips. What is your job as an investor? How can you manage your own portfolio? What is passive investing? What is active investing? And last but not least, we'll be doing some stock battles. And we have a few interesting ones, as you can see in the title of the stream for today. We'll be doing Pinduoduo versus Alibaba, two big Chinese stocks. And Pinduoduo is on a huge growth potential. Alibaba is a little bit more of a stable business, but we'll be seeing how they pair up. Pinduoduo and Alibaba, they're both active in the payment space in China. They're one of the two big ones. Alibaba does more, but we'll be doing a deep dive, so I won't get into it now. We'll be looking at Novo Nordisk versus Eli Lilly. The battle there continues to grow amongst the GLP-1 sellers. Let's call it what it is. They sell drugs, and let's see how they're doing. Let's have a little check-in. We looked at them a few weeks ago, and let's see if there's a development there. And we'll be talking about software stocks versus hardware stocks versus AI stocks. We'll be having another book tip to end it on. So let's dive into it with my surprise of the week. And as always, there's a little bit of a French touch. I have quite a good connection with French. My wife is French, so that's my diplomatic relation, or my diplomatic, how do you call it? My diplomatic responsibility, my duty as a European to connect our nations. We had a strategic marriage, based on love, but all the fun aside, I think my big surprise of the week, I read that the French are up to their 5th prime minister in just 21 months' time. That's absolutely insane. We're not doing much better here in the Netherlands. Our cabinet has failed as well, but the French are definitely worse off, and it shows. If we look at it from an economic perspective, this is a rare phenomenon, but you see that the corporate interest rates in France are lower than the national interest rates. Usually, you want a big discount on, or you want to get a discount, and from an investing perspective, that means you get more money or you pay less for the return you're getting on corporate investments or corporate bonds. And the reason why there's just a bigger risk when you buy corporate bonds, and the corporate interest rates being better than the national interest rates is something that rarely happens, and it shows that the trust in the market for the French government to get their business in order is very, very low. So we'll be seeing how that goes. But as always, politics can shift overnight. Stuff can happen very quickly, and the French can find a way to fix this. I'm sure of that, but it won't be easy. They'll probably be out on the streets. To me, huge surprise. 5th prime minister in a single 21 months. That's how often do you see that? I always think that America is going to shit with Mr. Trump, but a little closer to home, we have problems as well. Let's dive into the news of last week. First off, I think the big ticket item is the Fed cutting interest rates by a 1/4 percentage point. And the Fed has they're currently in quite a difficult position. They have a double mandate. They need to make sure that inflation stays low and that the employment rate is good. That's their dual mandate. And what we see in the US is that inflation is still relatively high, but the job market is shit, and those two conflict. Usually they're more in line, and that makes the job of the Fed a lot easier. And they had to act, I believe, and that's why they cut interest rates. And Trump obviously immediately criticized Jerome Powell, but I think he wanted more or bigger interest rate cut, and I assume that more interest rate cuts will follow, but he won't throw them all out, or he won't immediately do all his rate cuts. Then there is very little he can do afterwards. He wants to hold some of he has an elephant gun, or he has his own tools, and he doesn't want to use all his tools in one go. But the interest rates cut, we actually saw stocks drop a little bit. I think people expected a bigger interest rate cut than we got, even though we did get an interest rate cut, and usually that leads to high stock prices for the simple reason that businesses can invest in themselves a lot easier. Money becomes cheaper. So if you compare the interest rates from before and today, money is a lot cheaper now, so it's a lot easier for businesses to invest. And the reason why stocks also rise is because the interest rates that you can get on US Treasuries is currently lower, and that means the rate of return is lower, and stocks become a more interesting investment. You're willing to, the return there is higher, and you're taking a little bit more risk, but because your return on Treasuries is lower, stocks become more interesting. And I also think that Treasuries are still, I think the faith in the US government has lowered, and that might limit the return you can get on US Treasuries or on the payout rate of them. I don't think that's a big risk, but as always, risk is involved when you're investing. It doesn't matter where. There's always risk. I don't believe in a risk-free investment. Now, next up. Another interesting thing is that apparently the interest rate on mortgages rose despite the Fed rate cutting it. I don't really understand what's going on there. If you have an idea or understand what's happening there, please let us know. I think next week there will be let's look ahead slightly. There will be new home sales report. Might be interesting to look at and tie it into the mortgage rate. We'll be talking maybe more about this next week when we understand what's going on there. Next up, Intel surges 23% after a $5 billion Nvidia investment. Now, $5 billion sounds like a lot of money, but for Nvidia, this is about 10 days of free cash flow. And for Nvidia, this is a hugely strategic partnership. I think it makes a lot of sense. They can get their Nvidia, of course, make the GPU chips. They're massive for the AI race, and Intel creates CPU chips, and they want to create more chips. They got an investment from the US government, and with all those investments, they can build more factories and ramp up production. And for Nvidia, this could be a huge strategic play because they're less dependable on competitors of Intel that are all based overseas. A big one is TSMC, another one is Samsung. Intel being a powerhouse in the US could be beneficial for Nvidia. And if they want to approach, I think, mostly the consumer electric market, this partnership makes a lot of sense. In laptops, you use both type of chips, both made by Nvidia and Intel. They could create chips together, and I think that's the bigger newsworthiness in this article than just the $5 billion investment. Like I said before, $5 million in the entire chip market doesn't get you very far. But this strategic partnership and them creating something together, that's what's interesting here, and that's what you should pay attention to. And I'm very interested how this will play out. Intel apparently surged. I think for Nvidia, this is a smart play as well. Then we continue with the strategic and geopolitical interests. Oracle is going to take a stake in TikTok together with the Silver Lake Consortium, or I believe Oracle is part of the Silver Lake Consortium. And they'll be owning the US version of TikTok that will be responsible for the US operations of TikTok. they'll be owning 80% of it. The other 20% will be owned by by Chinese investors or by Chinese shareholders. And I think this is interesting. I think it's noteworthy. Oracle is becoming quite a big player. We talked about them last week, surging their stock price surged because they had a huge order book in their cloud services around AI, and now they're investing in TikTok. I think I'm not sure if it's still the fastest growing social media out there, but it's for sure the most popular one currently. That's about it. I don't really have any more to say about it. I don't know if this is a great play for them. I think the stock dropped on the news. It's not their core business, but it could be a great opportunity to make some money. And I think that's about it. That's the way they got into it. Let's say if there's anything else that's being talked about that we might have missed. Current users will be asked to shift. Apparently there will be a new app in the US. That's quite a shift. Wrote it report July. Yeah, they're launching a standalone app in the US. Separate algorithm and data systems. Now this is where Oracle is the huge player, and this investment for them makes sense. The data system can be provided by Oracle. Yeah, they would handle user data in Texas, locally. Yeah, all right. Great, good for them. I'm always interested how this plays out in the end. For me, this is not an investable case based on this news, but it's interesting to see and to follow and to see where this goes and where this will take us. There might be some pressure for Oracle to participate in this. They might be willing themselves to participate in this. But from a business perspective, this is not their core business. It won't become their core business. And I think it could be quite a struggle with the Chinese version of TikTok. We'll see how it goes. Another interesting phenomenon to talk about is the September effect. And this refers to historically weak stock market returns observed during the month of September. A buddy of mine talked about this. You might have heard this as well. I talked with a statistician about this, and he basically said, if you measure every month, there has to be a worse month, and apparently that's September. There is no real reason why this happens. There is no statistical evidence why this happens. There is some, but this depends on what time period you look at. According to Investopedia, there's some evidence of this happening, but it's not very strong. It's very dependable on what period you compare to one another. And I don't know. It's not something as an investor it's not something you can act on. If you sell all your stocks before September and buy everything in October, or buy everything in September and sell it the month before, then this is not something that can last very long. And most economists and market professionals discount the existence of the September effect. This could also create it. Some consider the observed weakness in September to be attributable to seasonal behavioral bias, as investors make portfolio changes to cash in at summer's end. Could be true. It's more of an anomaly. I thought it was interesting to talk about. Sometimes there are these statistics that float around stock investing and around stock market and on Wall Street. There doesn't necessarily have to be any truth behind it, but it becomes its own living myth. And I think the September effect is one of those effects. Some people know it happens. Another one of those statistics that apparently on Monday, that's the worst day for stocks. Again, if you look at all the days, there has to be a worse day, and apparently that's Monday. Maybe after the weekend, everybody had brilliant insights that they needed to sell, or they got depressed, they had to go back to work, so they want to sell. But that's a phenomenon that had actually been observed, and then everybody started compensating for it, and the effect disappeared. But it's still being talked about, and I think the September effect is in the same boat, in the same vein. So interesting from a stock market perspective to talk about on a more broad basis. Now for our news segment, we will end it off on what's going to happen next week and all the important events coming up. there is very, very, very little noteworthy going to happen. September is also a slow month when it comes to the news. Apparently, there will be a new home sales report. We talked about the Fed cutting interest rates, and we also saw mortgage rates going up. So this might be interesting to look at. There will also be initial unemployment. Don't really care about that. Existing home sales. We'll be getting earnings from Costco. That could be quite interesting. Personal income and outlays report. What's happening in the market this week? This is outdated. Okay. Well, that about does it for the news. Now we get to the meat and bones. We get to the fun part, and that is where we do our stock battles. Dun-dun-dun-dun. Now first let's log into our software. And first off, I want to start with Pinduoduo versus Alibaba. Let's open PD. Now, why do we want to look at Pinduoduo versus Alibaba? In China, Pinduoduo and Alibaba are the two major tech players, mostly when it comes to payment services. Pinduoduo, no, what am I saying? Not the payment services. Pinduoduo and Alibaba are the two biggest e-commerce players in China, and Pinduoduo owns Temu. They're cheap. They have grown massively. They have actually exploded in users. Alibaba has been around for a long time. They have other business lines, so they're more diversified, but they're losing market share to Pinduoduo. And in China, there is a huge e-commerce war going on. So from an investor perspective, how should you compare the two, and which one should you own if you should own any? Now, before we get into it, don't ever buy something because some guy on the internet tells you to buy something, or someone tells you this looks like a good investment. Do your own due diligence, do your own work, see if this fits your own style of investing and if it fits your portfolio. That's your job as an investor. Now, if this is something you're interested in, and if you want to understand stocks from a very fundamental perspective, the way Warren Buffett does, then you're here, then you're in the right place. Over here at Market Daddy, we do a live stream every Sunday. You can ask questions about your own portfolio, about stocks you're interested in, or if you have questions about investing in general, whether you want to understand it can be anything, whether you want to understand what a PE ratio is, dividend, should you want a dividend, yes or no? How do you build a portfolio? If you had $10,000 in cash, what would you invest in? You can ask all those questions live over here to us, to me, to everybody here in the chat, to our community. And the second way we do this is by using our software. We buy validated data from a third party. It's the highest quality around. We have our own algorithm and AI systems doing a lot of the analysis work and the legwork for you. So you can quickly get an oversight of whether a stock is interesting for you, yes or no, and whether something is worth investing more time in. Now, we'll be using our software every live stream. You can understand how it works, where the value is, but you can also try it out yourself. You can go to marketdaddy.ai. You can try it out for free for 7 days. If you don't like it, you can cancel anytime. We believe the software speaks for itself and you will be convinced. Then you can pay a small subscription fee every month or every year or every quarter, and you can use it as many times, as much as you want, and do your own stock analysis and put your money to work. Now, let's get into it. We'll be starting off by Pinduoduo. This is the new kid on the block. They own Temu. We are having the PDD that's being sold on the Nasdaq, the US version, but they're of course a Chinese business. They're in specialty retail. What has their price done? Well, if we look at the last 5 years, they've grown more than 60%. If we look at a year to date, they've grown 30% plus. And last six months, only then they're down a little bit. Yeah, but they're doing well. Last 5 days, they're down as well. But from an overall perspective, They started somewhere 2020. Great. Their market cap, 180,000 million US dollars. They're trading quite low. Now, as always, when we want to analyze a stock, we'll be asking our 3 important questions. Are we buying a great business? Are we buying a great business? Can we buy it at a great price? And can we reliably predict it for the future? Now, to answer these questions, we use our AI analysis. According to all of the great value investors of our time, they have talked about how they invest, what they look at in a business, and what they find important. And on all that data, our algorithm looks at the stock and sees whether or not all these great value investors would consider this a great business, that you can buy at a great price, and that you can reliably predict for the future. According to our algorithm, this is not a great business, but we can buy it for a great price, and we can reliably predict it for the future. Now we get a quick overview of what they offer, and this due diligence is based on the last 5 earnings calls, or five quarters of earnings calls that they had. It scrapes all of the important information. It looks at how the management talks about their business, about the sentiment, and most of these earnings calls are sales pitches in the skies, but we filter through the noise and we get down to the meat and bones, and we summarize this to you in a very, very easy to read, easy to digest AI report, and you can take all the key highlights from this. And this data, again, is verified, is validated. You can rely on this. Pinduoduo makes e-commerce solutions for consumers and merchants. Their business model is focused on creating a robust ecosystem. They earn money through transaction fees, advertising, and merchant services. Yeah. They basically create a platform. Anyone who wants to sell goods can sign up to that platform and can sell their goods through Pinduoduo's platform. And Pinduoduo makes they charge a fee over every transaction that takes place on their platform. That's what they earn. That's where they earn their money. They can also offer extra services to merchants. This might be pay now or no. What is it? Buy now, pay later services. It could be inventory management. It could be creating a nice web shop. It could be any kind of service that they want to offer. One of those, I think a big one of those is advertising. You can see it as a merchant service, but they define it as their own business line. And the merchants are paying for advertising for their products. That's how they earn money. Now, what is their competitive advantage? They have a solid edge through its extensive merchant support programs. The Renminbi 100 billion initiative shows commitment to helping merchants to thrive. This is the 100 billion initiative is something that Pinduoduo came up with, and it's basically a lot of cash to help merchants. And they use this to create loyalty. They basically buy market share. That's what it is. They buy themselves into the market by spending a lot of cash. So merchants get attached to the platform, and the idea is that once a merchant is in your platform, he's very unlikely to go somewhere else. And they call it creating loyalty and strengthening their platform. Basically, they're buying users. Come over here, you get cash. Well, makes it very attractive. It's not something that you can maintain for the long run, because this is a cash bleeder. And from a business perspective, you want to earn money and you want to earn more than you spend. And the bigger that gap is between what you earn and what you spend, the better, the higher quality business you have. And this also shows whether you have a moat or not. If you have really high margins and you can get to keep a lot of the money or a lot of the money from sales, you can keep in your own pocket without having to spend it on marketing, advertising, or these kind of initiatives. That makes you a higher quality business. They focus on high quality development for small and medium-sized enterprises. Their growth momentum is tied to strategic investments. They're willing to accept lower profits now for future gains. Their logistics support in remote areas and consumer campaigns. Yeah, they aim to drive sales and order growth. So they have a long-term vision. I always like reading that management has a long-term vision. I want to invest into a business for the long term. I want to put my money into the business and make sure that the business can run itself. I don't want to have to look at the ticker every week, every month. I might look at it every year, but that's about enough. And then it can create value on its own. If you have a business that's very volatile, very high risk, that's focused on today, but not on tomorrow, I don't get to sleep very well because I have to keep a close eye on it. And that's not what I want to do. I want the management to keep a close eye on the long-term success of the business so that I can take my hands off the wheel and get rich the easy way. Their future expectations. Again, focus on long-term value creation. They acknowledge that revenue growth has moderated, but they believe in the potential of their ecosystem investments. They focus on agri-tech, on global markets. They're preparing for future innovation and efficiency. Yeah, that could be quite interesting. They're committed to merchant support, short-term profit declines, focus on agri-tech. Okay, cool. Now, if we want to look at their our valuation lab. No, first off, I want to look at is this a great business or not, and whether or not I agree with this. I always like to look at liquidity, and we can go to our ratio radar, and we can look at their debt to equity. Extremely low. Extremely low. This means they have a lot of cash on hand and very, very little debt. So from a liquidity perspective, they're doing great. Now, let's look at their free cash flow. Is it stated over here? Just their price to free cash flow and their net margins, I think is an interesting thing to look at. Here, operational free cash flow. And that's not too great. No. I think from a liquidity perspective, they're doing great. Their debt to equity is low. That's what you want to see. From a margin perspective, they're doing really well, 28.5. Net margin, that means from how much actually reaches investors. So gross margin is out of every sale they have to make certain costs to make that sale. That could be materials they have to buy. It could be people. If you are an employment agency, you have to pay the salaries of the people that you employ. For a business like this, it's mostly software, so it could be some kind of data center or some other kind of energy bill that you could have to pay before you can actually sell your product or services. The operating margin is what you have to pay to operate your own business after all those sales have happened. And then the net margin is actually the cash that can be transferred to you as an investor. And that's what you're interested in. You're always interested in the margin or in the statistics and the ratios that benefit you the most directly. And that margin is one of those. 28.5 is really, really good. Therefore, it's very, very green. If you look at their return on invested capital, it's also quite high, 28.35. I myself aim at a 15% return on capital for my own investments. They are beating me about almost 2 times as much. So this is a great place to store your cash if you just look at their return on invested capital. Now, let's see at their financial statements. I want to take a look at their cash flow. And specifically the free cash flow. And what you want to see is that it's very stable, or at least, and most importantly, you want to see it grow. Now, from a free cash flow perspective, this is on the far right. That's the oldest year, and the closer you get to the free cash flow, that's the youngest year. So that would be for 2024. 2025 isn't yet completed. We can look at it from a per quarter perspective, and then we can use the 2025 Q2 data. But for now, I'm interested in the year-on-year data, and you can see that it's growing. There's a few dips here. That might be COVID. COVID has hit China quite hard, and then it explodes again. So is it stable? I wouldn't necessarily call it very stable. If we look at the quarter data, you can see we get the 2025 Q2 data, and yeah, this looks a little bit better. So more recently, they've been doing quite good, but it seems to not be on a high right now. Let's look at their growth graphs. You can see that their revenue is actually absolutely explosive. I think, or I'm sure, this uses yearly data, and the last few quarters, their growth has slowed down a bit. There's a lot of China fear built in. Now, I think the revenue growth is looking good, and their free cash flow growth is looking good as well. Their return on invested capital was quite terrible. Cash to debt, great, and still improving. Look, this is the big kicker. I think this is why it's discounted, and why we can't say it's a great business. They're handing out shares like crazy, even though they have a huge cash reserve. The reason why you would give out shares is to gain cash, and that cash, you can use that cash to invest in your business and grow your business. Now they have a great return on invested capital, but the downside of handing out shares is that you as a shareholder get diluted. You are sharing the same pie with more people, and that means that your shares will be worth less. That's not what you want, and they seem to be doing this quite consistently, and they seem to be improving, or they're worsening their handing out of shares. That's not what I like to see, and I don't really understand why. They have their cash flow is huge. They have a lot of cash on hand, so why do they hand out shares? I like everything else I see except that part, and this shows to me that I can't really that I'm not on the same level as their management. I don't really understand why their management is doing this, and it could mean that they could make other decisions that are not in line with my best interests. So I would agree with downgrading this from a great business to a good business just based on this. We want to be highly critical in our analysis process. You never have all the information. You always get information that's outdated because we can't look into the future, but there's a delay from when the business and the management knows about something and when you as a stockholder, as a shareholder, gets taken along in the journey. That delay gives you a disadvantage. So when you look at the data, you want to be extremely critical and make sure that you as a shareholder, as an investor, have a really high margin of safety. That means that your investment is better off for the long term. You sleep better at night. You want to look out for yourself first. So don't get taken along by a great story or by a great product. Look at what's in front of you. If you see something you don't like, you need to use it to devalue the company in your own head. You need to be intellectually honest when you look at the data. And to me, shares outstanding growing this exponentially without a good reason for them to do so downgrades this from a great business to a good business. Now, if we look from a price perspective, there are a few metrics that we use for this. First of all, the price to earnings ratio. The market average is 15. This is 8.71, which is a lot lower. The same for price to free cash flow. It's also a lot lower, roughly 8. Their earnings yield is basically the inverse of the price to earnings in relation to the stock price. And then you see that you can make an 11.5% return. Now, all these factors show that that it's priced very cheaply. Their free cash flow yield is a little bit lower. Their free cash flow it's quite unstable. So apparently this is a bad year for them, or a bad moment. And they don't have a dividend, so you don't get a dividend yield. Now, just looking at these, I would say it could be quite cheap. But what we want to look at to test this assumption is our own valuation lab. You can use 3 scenarios, and you can calculate revenue growth, the desired exit multiple, your desired rate of return, and how much you weigh each of these scenarios, and whether you want to base this on the earnings yield, on the free cash flow yield, or on the dividend yield. Now, this company doesn't pay a dividend. You wouldn't buy this for the dividend, so you wouldn't use the dividend yield. I think the free cash flow is very hard to predict, so I would base this on the earnings yield. I think that's the most reliable assumption that you can make. Historically, they've grown 55%. That's insane. We'll be doing an analysis for the next 10 years. You can't expect a business to grow at 50% for the next 10 years. That means they would double every 2 years or less than 2 years. That's not a sustainable growth path. So you want to be realistic here. I think in the best case scenario, let's say they manage to keep growing, but at 25% for 10 years. That's already incredible. And I would be willing to pay a higher multiple for that. So currently we're paying 8.7. I think there's a lot of fear around China. That's why it's being discounted. There's a lot of competition in China for e-commerce. Again, a reason why it's getting a lower multiple. But this is already priced in. Now, if they do manage to get 25% growth, it doesn't really matter whether or not the competition grows more or not. This is a great business to own. So I would be willing to pay a higher multiple, and we're going to base that off the market average, which is 15, and we will be paying more than 15 for the 25% growth, quite significantly, let's say 25. And I always aim at a 15% return, and we can use that for all scenarios. Whether or not the company is doing great, whether or not the company is doing bad, I want to get paid, and I want to get paid at least 15% every single year. That's why I use 15% for all 3 scenarios. Now for the revenue growth, in the normal case, I think we're going to look at a little bit more of an average scenario. And I think for the worst case, let's say they lose the race, they can barely grow at only 5%, and there's a lot of China fear still around, so we're going to even lower the exit multiple even more. Usually, all of these scenarios are a little bit closer together, but because Pinduoduo, for me, from a reliability perspective, is a little bit harder to predict. Their free cash flow is already quite unstable, but their growth over the last year has been so stable and so significant that our AI model still calls it very predictable. I still have some questions. And if we run the valuation, there's a massive upside. Massive upside. And I think that's mostly due to the multiple expansions. It's getting absolutely downgraded into the mud. And there are some significant, even in our worst case scenario, you're looking at a valuation of about 222 based on these assumptions. Now, once again, don't go out and buy something because some guy on the internet tells you something is a great investment. Do your own due diligence, do your own work. You can use our software to put in your own numbers and see what kind of valuations that you can come up with. But from a valuation perspective, it's a great business. Or it's a great price. I'm sorry. From a valuation perspective, this is a great price. And the current price is $129.47. And each of our scenarios beats it. And if we blend them all together, we're looking at $1,800. That's a significant return. Now, even though it's not a great business, and we just called it good business, having a really, really, really attractive price, that's what we're looking at now, could make this a great investment. But then we still want something that we can reliably predict for the future. And I think Pinduoduo, their cash flow, free cash flow, not very reliable. It's never been negative, but it's looking good. But mostly them handing out shares and me not understanding why management does this means that I can't reliably predict what they're going to do next, and that they're going to make decisions in my best interest. And on top of that, I think the whole e-commerce battle in China, I'm willing to wait and see how it plays out. I can't predict how this will turn out in the future. I can only see that the competition currently is huge. Pinduoduo could be one of the winners. They could also lose, and in that case, you're off quite badly. You don't want that. So, from a business perspective, are they great? No. From a price perspective, amazing. From a predictability perspective, you can get better out there. So for me, this wouldn't be an investment. It would be something I would put on my watch list. Let's add it to our watch list. And I want to keep an eye out on this. I want to see how the competition in China develops. I want to see whether or not they continue handing out all these shares, and I want to see if their valuations change at all. Currently, not a great business, but it has a great price, but again, no reliability. Now, if we compare it to one of their biggest competitors, which is Alibaba, we see that they have grown. They have actually slunk, is that a word? They have decreased in value over the last 5 years by almost 41%. Recently, they have done quite a lot better, 94%. A little disclaimer, I've owned Alibaba for quite some time now. I've owned it, I think since 2020. I would be inclined to say 2023. I saw it peak, and I saw it dip quite massively. I think I bought it maybe even around 2022. I saw it dip quite massively, and currently we're up a little bit. And I'm up overall, but disclaimer, I own this. Again, don't buy something because someone on the internet says you need to buy something. But we want to take a look at Alibaba. We just looked at Pinduoduo. We saw how they were doing. For us, it's not an investment, but something to keep an eye on. So we put it on our watch list. Now, Alibaba is something that we already own, but we want to look at this business from the same perspective. Are we buying a great business? Can we buy it at a great price? And can we reliably predict it for the future? Now, let's go to our AI analysis. It's not looking good. It's telling us it's not a great business. We can't buy it for a great price. And it's not very easy to reliably predict for the future. And I would be inclined to agree on all 3 points. When let's talk about it now. The reason why I bought it, they had a great free cash flow. Their free cash flow has basically disappeared. I think for a good reason, because they're investing in AI. And they only recently shown that they could get a great return on this investment by growing their AI business by 36%. But that's only recently. We don't know how this plays out. Their e-commerce business line is still depressed, or it's not doing as great. We talked about this for Pinduoduo as well. There's a lot of competition out there. Now, Alibaba, they also have their e-commerce, just as Pinduoduo does, but they also have cloud computing and AI products for consumers and businesses. So they are way more diversified, and their business model is a mix of their online retail and their cloud services. This is similar to Pinduoduo. They also earn money through transaction fees and advertising, but their cloud subscriptions is what sets them apart. And I think for future readiness, this is already looking better, and in my mind gives them a little bit of an edge over Pinduoduo. Now, can we see why they're not being why they don't meet the great business quality? The revenue has grown only slightly. We want to see more growth. Their free cash flow growth has been negative. You want to see growth here as well. And the return on invested capital is also it's not very interesting. It's nothing to write home about. We're aiming at 15%. They're not beating that. Their cash to debt, however, is looking good. And this is an important difference from Pinduoduo. They don't hand out more shares. They actually buy back shares. And especially with their low valuations, great job. Great use of their cash. If you can buy your own stock at a low price, it means you believe in your own business. You don't dilute me as a shareholder, but you reward me as a shareholder through bad times. And it could also help drive up the share price. So from that perspective, great. Cash to debt perspective, great. Every other perspective, not looking too good. Now, can we find out why this is not a great price? So first up, we're going to look at the quick scorecard to get an overview of the valuation. PE above 15, above market average. So you're paying more than market average for a business that doesn't grow too much and doesn't have a great return on invested capital. The price to free cash flow is even higher, even worse. Their earnings yield is 5.77. Again, you want 15%, or I aim at 15%. Market average historically has been about 7 to 8%. They're below that. Free cash flow yields massively below that. They do pay a dividend. Another thing that sets them apart from Pinduoduo, if you're interested in receiving a dividend, Alibaba is the place to be. So this already tells me from a valuation perspective, they're more expensive than Pinduoduo, and let's put them through our valuation lab. Now, best case scenario, let's say they can continue their AI growth path. From a normal case, they continue what they've been on, and from a worst case perspective, I would upgrade them from Pinduoduo a little bit. We put that about 5%, if I believe, but because they have more business lines, Alibaba is a little bit more reliable. They have less of those ups and downs that Pinduoduo had. I'm willing to up my worst case scenario a little bit. Now again, I would be willing to overpay for the best case. For normal case, we do about 15, and for the worst case, we'll do 10. And we'll be aiming at a 15% return. Also a massive upside. Massive upside. Current price, 162. Best case, massive upside from all scenarios. So based on these scenarios, they're doing great. Now, if we tune this down a little bit, let's say our best case scenario is 15%. Then they're doing about 13 and 11. And we're giving that a 15, 13, and 11 PE as well. We still are looking at a massive upside. If these are the assumptions that we make about the business for Alibaba, we're still looking at a massive upside. And it would mean we can get it at a great price, and would actually disagree with our AI analysis. But this is on the assumption that they keep growing quite strongly. Let's say what will they use? Yeah, I think they're using, not looking too bad. So from a price perspective, I would say they're looking good. From a reliability perspective, Alibaba, they have more business lines, which is a little harder to predict, but I think they're less dependable on just the e-commerce section, whereas Pinduoduo is dependent on the e-commerce section, and the entire competitive space that it is. It makes it very hard to predict what will happen and who will come out on top. Alibaba also being active in the cloud computing and AI space make them a little bit more dependable, a little more reliable, because you can depend on their other business lines to generate revenue. And from a trend perspective, I think the whole AI and cloud computing trend is going to continue. And over here in the West, we only look at the US tech stocks. We look at Amazon. I think Alibaba is the Amazon of the East. And what was I saying? Yeah, for the West, I think Amazon is a big player. And if we look at cloud services, we look at Amazon. I think if you live over in Asia and in the East, you look out to Alibaba. I think that's what you rely on and depend on. And China is a huge player in Asia. They will continue to be a huge player in Asia. They're a huge player in Africa, in India, and those are all growth markets. And I think as long as they grow, both Alibaba but also Pinduoduo could benefit there quite massively. So they have a lot of room for expansion. I think their home e-commerce, I think at their at home in China, their whole e-commerce debacle is what they got to tackle first, and I think that's the most important dilemma or risk that you need to solve, or that China needs to solve if you want to invest in any one of those two stocks. From a reliability perspective, I would give it to Alibaba and say this is the more reliable business than compared to Pinduoduo. So Alibaba is the more reliable business compared to Pinduoduo. Now, if we compare the two, they're both Chinese e-commerce stocks. One is only reliant on e-commerce, has seen massive growth, but the growth is decreasing. The other is already huge, is the incumbent, has been around the block, They don't only have the e-commerce section, but they also have their AI and cloud computing section, which makes them a huge player, not only in e-commerce, but internationally in the entire cloud space around Asia, Africa, India. Pinduoduo, it's not a great business, or it's just a good business. From a price perspective, they're hugely undervalued, but they're very hard to predict because it's very hard to see what's going on in China and who's winning the e-commerce race. Then if we look at Alibaba, from a business perspective, they're more reliable, but they grow less. Their return on invested capital is lower. The only saving grace is that they buy back more shares, whereas Pinduoduo hands out shares, and that's not what you want to see. From a valuation perspective, Pinduoduo is incredibly cheap, and Alibaba seems to be cheap as well, but a little bit less cheap than Pinduoduo. From a predictability perspective, Pinduoduo is very hard to predict due to the Chinese e-commerce battle that's going on, and them being incredibly dependent on the outcome of that whole battle going on there. Whereas Alibaba is a lot more diversified, and they have a big future growth industry in AI and cloud computing. I would hand it, I'm a little bit biased, I own Alibaba shares, but I would say Alibaba is the better business to own. But Pinduoduo does offer an opportunity at the incredibly low valuations. So I would definitely put that on your watch list as well. Now, we're going to move on to the last stock battle. Oh, a little bit too quick. We're going to look at Novo Nordisk, and we're going to compare it to Eli Lilly. They're both both the biggest players in the weight loss drug market right now. Novo Nordisk was the first and was the highest valued company in the entirety of Europe. Eli Lilly is currently outpacing Novo Nordisk, and they're outselling them in the US. One of the big differences between the two as well, Novo Nordisk uses medication that you have to inject. Eli Lilly uses a pill form. From a patient perspective, that's just a lot nicer, as you can imagine. Novo Nordisk is developing the pill version as well, and they have more being researched as well. Now, those are the products, but we're going to look at the two. We're going to look at the two businesses from a business and from a stock perspective, and see which one is the one you should own, if any at all, and how can you compare the two. We do this by using our software, marketdaddy.ai. We have validated data that we buy from a third party. We can make sure that the data is accurate. We have our own algorithm to determine whether this is a great business, whether something can be bought at a great price, whether you can reliably predict it for the future or not. And you can use this yourself as well. You can try it out for free over at marketdaddy.ai. If you don't like it, you can cancel anytime, no questions asked. If you do, you can stay around, pay a small subscription fee, and you can use it for as many stocks as you like, and use and do your own analysis to put your money to work and make sure your financial future is secure. Now, if we look at Novo Nordisk, let's look at our AI analysis. It's a great business. It's not a great price. If you look at their valuations, it's quite highly valued, but it can be reliably predicted for the future. So already looking good. Now let's take a quick look at their graphs. Revenue growth is through the roof. Free cash flow growth through the roof. Return on invested capital through the roof. Cash to debt. Okay, that's declining a little bit, but still relatively solid. And shares outstanding. They're buying back shares. Great. This is what we want to see. Now, if we value it and see what they can do, they've last grown for almost 25%. Huge. Let's say they can continue that for the next 20 years, but a little bit lower. Normal case, let's say they grow about 15%, and worst case, they can only do 10%. Eli Lilly is beating them, but they can still grow a little bit because the entire market is growing for weight loss drugs. Now, exit multiple, I'd be willing to pay more for a 20% revenue growth. Normal case, I'd be willing to pay market average, and worst case, let's do below market average. And I'm aiming for a 15% return, whether or not the company is doing good or bad. I want to get paid first. Now we run our valuation. You can see that it's actually slightly undervalued. We calculate it's worth about 450 based on our own assumptions, and the current stock price is only 388. That means you have an upside of about 15.7% based on our assumptions. Now, never trust something because some guy on the internet tells you it's a great buy. Do your own due diligence. You can gain access to our software, use your own inputs, and get your own valuation. But currently we can see this is what Novo Nordisk is worth. Now, if we compare this to Eli Lilly, they're also a drug manufacturer. They're also very active in the weight loss industry. Let's see what our AI analysis has to say about this. It's not a great business. Can't be bought at a great price. Hugely overvalued. A price to free cash flow is almost 1700. That's massively overvalued. Also a PE of 65. Barely any returns, barely any dividends, and it's very hard to reliably predict for the future. Now, if we try to value it, if we look at their return, let's say they can beat that, and the normal at 15 and then 10. This was the same as Novo Nordisk, but let's say we can do this. Now, I would be willing to overpay for 20% growth, but I'm not willing to pay 65 times their earnings. I would be willing to pay 25, 20, no, market average, 15 and 10, and I want 15% return. And it's massively overpriced. So everybody is talking about how Novo Nordisk is losing the weight loss race to Eli Lilly. But if we just look at the valuation and if we predict what the company is going to do, even if Eli Lilly grows massively, you're not getting any return. And this is the risk of investing in a good story. You can pay way too much for a great story, and that can hurt you in the long run. Now, Novo Nordisk is from our valuation perspective, if you look at this, is the better business to own. And from a valuation perspective, it's a better entry point. Eli Lilly is currently valued at 750, but worth only 212. So you're overpaying about more than 70%. So that's how they pair up. And then we haven't even talked about all the drugs they're developing. Now, if you're interested in any one of these companies, be sure to do your own due diligence and do a deep dive and see whether or not this is the right fit for you and whether or not you want to buy into it. But if we compare them very strictly, Novo Nordisk comes out on top. It is the better business, you can buy it for a better price, and you can more reliably predict it for the future. Now, something else we want to talk about, and that's what is your job as an investor? Your job is to manage risk. You want to generate return without losing your money. The most important thing is to not lose your money. Only then can you make a return. Now, when we talk about risk, what does that entail? Risk means actually losing your money. And when people talk about risk, they often talk about the volatility as well. And volatility is the fluctuations in price. So if we look at, let's say, can we draw something? Yes. If we look at risk, and let's say this is the price, this is time. That means if you buy something, it looks like it's going up. If it can go down to 0, that's risk. Now, if we look at, again, price, time for volatility, that means something can go like this. As an investor, what do you want? You want volatility because you can buy here and sell here. Important thing, volatility is not the same as risk, but risk always involves volatility. As you can see, the price is going up and then massively tanks. But from an investment perspective, the difference is that volatility means it can go up again, whereas risk is just you losing your money. Now, how can you mitigate risk and profit from volatility? We can draw that out as well. Your job isn't to predict the future, but it's to manage your risk well. And the way you can do that is by creating a portfolio that's set up to limit the amount of risk and profit from volatility. One way to do this is to create a portfolio that consists of not only stocks and not only individual stock picks, but also of other assets. And one of those could be ETFs, which already diversifies you across a huge range of stocks. It's very passive. You can just buy an ETF. You don't have to look at it. Then you can use a small part of your portfolio for something that's not related to stocks at all. This used to be bonds. And a rule of thumb is that you buy bonds, your percentage of your portfolio that's invested in bonds is the same as your age. So as you're younger, you have less bonds than when you're older. And the reason for this is that bonds are very stable. They are not volatile. They're not risky. If you buy US treasuries, you get a small return, but you get a return almost always. Now, there is no investment that contains zero risk, but this is the risk-free rate as when we talk about investing. And this is as risk-free as it can get. Once again, there is never no risk, but this is the least amount of risk you can take on. That means that your money can't go to zero, and you always have some cash on hand for living your life. Now, the reason why you want to limit risk is because if you lose your money, you can never make any return. The reason why you want to have a portfolio that you can the reason why you want to look at your portfolio and build it in such a way that you limit risk and profit from volatility is that there can always be a point in time in your life where you need cash from your investments, and then you want something that gives you a good rate of return without you cutting into your profits or cutting into your initial investment. And a good rule of thumb or a good way to look at it is you first need to survive in order to grow. And if you grow, you want to use compounding. You want to make sure your money is put to work. You want to make sure it can compound, and that's why you want to invest it in the stock market. But you want to do it at a low amount of risk, a good amount of return, and your return comes from volatility. Price is never an information point, but it's there for you to take advantage of. If you can buy something for cheap and sell it high, that's where you make your money. Now, a way to build your portfolio, let's say this is 100%. The way I do it, about what is 35? About 35% is invested in 35% is invested in gold. And the reason why, gold is a huge hedge against inflation. So if you hold cash, it's gonna be eaten up by inflation. And it's also a huge volatility counter compared to stocks. Stocks can be very volatile. If the whole market drops, gold will drop not as much. So it's a very stable asset. So if the stock market ever drops and I need money, I can sell some of my gold and be very liquid very quickly. Now, what I do with the rest of the percentage, for me, it's all in single stocks, in stock picking. 65% in stock picking. Now, most modern portfolio theorists say that that's a bad idea. So let's delete this. And they say you need to be invested in other assets. You could use your age, for me that would be 30, and put that 30% into bonds. Now, bonds are risk-free, so you won't lose your money. They're not volatile, so you won't make a lot of money, but they'll make sure that this part of your portfolio is there for you when you retire. It will generate a small amount of return, and you can use it whenever you're older. And then everything that's left, you can use that for the stock market and invest it in stocks. And you can make another distinction there. So we use 65%, which leaves us 35%, but let's split it up and got this 17 and a half, boom, boom, boom. And this is 17 and a half again. You can use 17.5% into passive investing, and you can use this to invest in ETFs. ETFs they involve a little bit more risk when you compare them to bonds and to stocks, but they are a little bit more volatile, which means you can earn more money investing that way. The reason why they're safer is because when you buy an ETF, you buy a huge amount of stocks, a huge diversified basket of stocks, and you profit from them going up as a whole. You don't need to look at a different type of stocks to build your own diversified portfolio. You can just buy a few ETFs and be very diversified and profit from the gains that you can make in the stock market. Now, one thing that's mostly overlooked, when you invest in ETFs, it doesn't necessarily mean that you are diversified. Currently, if you look at the S&P 500, I think about 65% is made up by the Magnificent Seven. They're so highly valued that they make up a huge percentage of most ETFs. And if you buy S&P 500 and then you also buy a world ETF, you're almost fully invested into US stocks, and even more specific in the Magnificent Seven. Because the World 500, I think about, what is it? They have a 65% exposure to the US. So that doesn't diversify you very much at all. And that's why I would always advise to do a small part of your portfolio. 17.5% is just top of my head, but you can play around with this. You can make it higher or lower depending on your risk tolerance and what you want from your portfolio. You can, if you want income, you could use the 17.5% to buy dividends. You could also buy a dividend ETF, but you can buy dividend stocks to get a little bit of income. You can also use it to buy stocks that have significant more volatility. You would also be taking on more risk, but the volatility allows you to supercharge the gains you can make. And that's what you want to use the 17.5% for. And now if you want to find the right stocks in the stock market, that's where you use our software, marketdaddy.ai. You can analyze every stock and see whether or not it's a great business, whether or not you can reliably, or whether or not you can buy it for a great price, and whether you can reliably predict it for the future. That's where we come in. For everything else, that's where we come in as well, but you can tune in every Sunday and ask questions about what's going on in the stock market, where to invest, and how to look at your portfolio. Now, before we leave you, we have one more thing to talk about. We have one more tip, and that's the book tip. One more tip, and that's the book tip. Today we have Why Nations Fail. And I think it's a great book. It's all about institutions, but it's about power and why some economies thrive while others collapse. And a few going theories, they say that, okay, the reason why economies fail or why others are successful is mostly due to their geographical location, or due to the people that live there, or they can be highly motivated, or they are very lazy, and that's why a country is failing. But this book basically states, no, that's not true. The reason why economies fail or why nations fail is inclusive institutions from both the economic and the power perspective. If you create inclusive institutions, people can actually use these institutions to better themselves and better their nation. And if you have extractive institutions, there will always be someone on top taking advantage of the nation and preventing anybody from bettering their nation, and that's why nations fail. Now, I do a bad job of explaining it. The authors do a way better job. It's very interesting to read. They have a lot of examples, a lot of real-world examples. They go everywhere, from the United States to developing countries to England, over to Asia. Hugely interesting read. Why Nations Fail. Be sure to pick it up. All right, and I think that takes us to the end of our of the live stream for today. We talked about everything that happened in the stock market. We talked about the Fed rate cuts. We talked about Nvidia investing in Intel and gaining a strategic partnership. We talked about Oracle buying themselves into the US version of TikTok. We talked about the September effect. We had some very interesting stock battles. We compared Pinduoduo to Alibaba. We also compared Novo Nordisk to Eli Lilly. and we talked about how to build a great portfolio and your job as an investor. And of course, we ended it on the book tip, Why Nations Fail. Be sure to tune in, and next week we'll be looking at everything that has happened in the market or that will happen in the market. You can ask your questions about your own portfolio and about the own stocks that you're interested in. You can reach us on Twitter, Market Daddy, on Instagram, TikTok, YouTube, Twitch. You can go to our website. You can even reach us via email. Be sure to check it out. You can try our website for free for 7 days. There are no strings attached. You can cancel anytime. And we'll see you next week over here live on Twitch and on other Cashflow Sundays. Thanks for watching, and goodbye.